publisher of the Daily Dirt Nap, a financial newsletter for investment professionals. So we've done quite a few episodes now, and most of them have been what I would call lowbrow finance. Today we're going to switch gears and talk about some highbrow finance. We have with us today one of the foremost experts in equity derivatives, Dean Curnutt, the CEO of Macro Risk Advisors, a derivatives broker-dealer. MRA is known for putting out some of the best research on equity volatility, some of the smartest stuff out there, and they've been succeeding in a business that a lot of people have had a tough time in lately. Before MRA, Dean was a managing director and head of sales trading at B of A. He also ran equity derivatives and convert sales. A long time ago, he got his MBA from the University of Chicago in analytical finance. Dean, welcome to the show.
Thanks, glad to be on.
Now, you probably thought we were going to have some high-level discussions about volatility, and we'll get to that eventually. But what I really want to start off talking about is what it's like to run a business in the securities industry. And a lot of people know about the investment advisor business module, what it's like to run a hedge fund, but nobody really knows what it's like to run a broker-dealer. So what I want to go back to when you were at B of A, and maybe you can start off by telling us a little bit about your time there. But at what point did you decide to go off and start your own broker-dealer? And what was that decision process like?
Yeah, so at Bank of America, I, over time, rose up to run equity sales trading. And that was a business that comprised different groups of sales traders, convertibles, derivatives, equity derivatives, risk arb, programs, and cash sales trading. And so for us at Bank of America, the core thing that we were looking to deliver to clients, I always found to be consistency. Especially on the derivative side. Remember, this was so my time at Bank of America was up until the end of 2007.
So pre-Merrill.
Pre-Merrill,
yeah.
Yes. And you had a period, I would say, from maybe 2002 to 2007, where even as volatility was in the process of receding from low levels. And getting lower and lower, the VIX went below 10 in late 06 and early 07. The sizing of trades during that period of the credit bubble was just continually larger.
Yeah, huge amounts of liquidity.
Huge liquidity, and people's books on the buy side just got bigger and bigger and bigger. It was probably all one giant carry trade. What we did well, so we had a blocking and tackling derivatives business on the equity side, and the name of the game was to smartly provide liquidity, as you mentioned, to your clients. So you had to offer your balance sheet really to facilitate risk transfer. I think what was tricky about it was that not every client was of equal value to the firm. So, some clients' trades were especially difficult. You'd have a big information asymmetry.
That sounds familiar.
Yeah, right. So from your book in providing ETF liquidity, you get the information asymmetry, the winner's curse, so to speak. And so you really had to acknowledge that there was, in many cases, a winner's curse, but that the value of flow was also substantially important. And what we, I think, did very well was to provide a lot of liquidity. We took a lot of risk, but to do so in a smart, thoughtful fashion where both the sales and the trading team were aligned in trying to pursue client business in an objective fashion, taking plenty of nicks along the way from a loss standpoint, but also building up one of the largest, if not the largest, listed options desk in the markets at the time. So that was a unique model. The onset of the credit crisis was late 2007, and it just my time at Bank of America came to an end, and I was going to do either one of two things. I certainly really loved the business and thought that the opportunity, especially then, to really help clients think about risk in markets was critically important. Remember, this was late 07, early 08. We saw the onset of the crisis, but we hadn't gone full-blown crisis yet. But I certainly knew something was up, and I knew that the potential for either gain or loss was significantly high. So I had an opportunity to either go to essentially do a similar role at a large bank or to try something entrepreneurial. And just with the backing of some incredible clients, was able to really think through the process of creating an independent firm that had a value proposition and set out to build a broker-dealer starting in early 2008.
Well, it really helps when you have some clients to back you in the beginning. I know what that's like. So can you tell us a little bit about, I mean, if I were to start a broker-dealer, I would not even know where to begin. It sounds like the hardest thing in the world, just in terms of all the legal and regulatory stuff you have to go through. Never mind just the usual business hassles like renting office space and hiring people and IT. Like, I know how, usually when you solve a problem, you solve one problem, then you solve another problem, and you just go through it. But just what was that like, especially, since you were starting this business in what turned out to be the financial crisis? Yeah,
so the first thing that my view was, I wanted to, even though there was a long list of items, and you highlighted several of them, to look into and to explore and ultimately to implement in order to actually start the business, I really sought to stay very connected to the clients the entire time. And so my view was, if we could be providing value and thought process during the period over which there's a necessary time that it takes to satisfy all of the paperwork requirements to actually become a FINRA licensed broker-dealer, I wanted to stay engaged with clients during that time. So I built this very rudimentary website and just started posting a thought piece each week. And very derivative-centric, very macro-centric, but that was my commitment, was to stay entirely focused on the clients during that time, even if I was unable to actually execute any trades or monetize the thought process. I wanted that to be seamless. There is a long list of things to do. I just had a whiteboard, and it was website, it was forming an LLC, things like bank accounts. Of course, spent a lot of time looking for space, finding a vendor that would help scope out the health insurance, the payroll. It turns out that there's a lot of vendor type support relationships that you can strike. For example, we were small enough in which a full-time chief technology officer, that didn't make sense. That's doesn't fit into a startup broker-dealer. You can, however, strike a contract with a vendor that commits to servicing the technology, helping you buy the computers and set them up, doing all the upgrades, and then if something goes wrong, they'll provide a certain amount of hours per month as per a contract, and commit to getting to you within a certain time frame. So that was a good kind of outsourced solution for us. And again, you can do the same thing with things like payroll and insurance as well. The process of submitting an application to FINRA, it's a lengthy process. It's I wouldn't call it brain surgery by any stretch. It's just there's a lot of paperwork to turn, and then there's a back and forth process where they'll ask you for some clarifications. You're in a queue effectively. I think it helps to have an outside attorney just pushing the process along. I think that's a reasonable thing to pay for, to push the process along. But for us, it was a 7 to 8 month process. It just takes that long. I can say it's funny.
So all this time, you're still posting on your website just to keep share of mind with your potential clients.
And that was really, really critical to me. It just, we were going through a period where the VIX went to an intraday high of 89 in November of 2008. Had its all-time high close of 81 in November of 2008.
Yeah, you can't just be completely absent while that's going on.
Right.
Yeah.
Right. People needed the help, and for me especially, the financial crisis. It's the defining lesson for me philosophically from the reality that markets are pretty efficient. They function quite well in most circumstances. But we should always remember that these are fragile and can be really tested. And of course, this was the biggest test of all time. So the notion that market risk can feed on itself, that deleveraging events can become self-reinforcing, I think this is ultimately the lesson of 2008. And I think the insight that at least I believe I brought to the client base at that time was this, that the markets can attack themselves. And remember, going into the crisis, the sweet spot, if you were going to turn from defense to offense on the vol side, the sweet spot to sell equity vol was a VIX of around 45. That was about as far as it had gotten. You go back to LTCM. You go back to the 2002 credit event. You had these periods where the VIX got about as high as 45, and that turned out to be a great launching point to turn from vol buyer to vol seller. And of course, 2008 was all bets are off type of event.
Yeah. So what were some of the snags you hit along the way? Just as you remember.
Yeah, I think you get into the nitty gritty of seeing a lot of space as an example, and then thinking, okay, you learn that, this space looks really nice, but this building is really not equipped to handle a financial firm that's going to have a lot of computer power running through it. The air conditioning is not sufficient, and the lease negotiations become especially complex. You wind up seeing a space and it's got a tenant in it, and then you're trying to figure out how to have the tenant leave and you take the space over, and you wind up in evaluating really specific components of an exiting lease that becomes a new lease commitment on your part. So I think that certainly was one of them. But I think in general, it's really to me, the idea behind macro risk advisors was to go out and tell a story. And I think the story was very simply that the ability to participate in the client's process, to become an advocate for what they're trying to accomplish, and then to help them on the execution side, that need not just be the stomping ground of the big banks, especially then, because the whole notion of committing capital was getting a big rethink from the bank standpoint, because the risks of taking the other side of these trades when the volatility was so high, the amount of money that could be made in loss, as I'm sure you've experienced too, in these high vol periods can be enormous. And so banks were really rethinking their commitment, the commitments that they were willing and able to make to clients.
So just for the benefit of our listeners, talk to us about how the economics of a boutique broker-dealer work. So if I'm not mistaken, it's pretty simple. You publish research and you take in commissions on trades, and that's pretty much it, right?
Yeah, I think it is from my perspective, a nice and simple business model, and one that promotes a great deal of alignment with clients. And so you sort of step back and you think about the whole way in which an income statement works. You have the top line, which is the revenue. For us, it's the revenue associated with executing trades. We're paid a commission per trade. So maximizing that is really a function of doing lots of trades and hopefully doing trades that are of good size. That's the top line. And then from a cost standpoint, pretty predictable costs. You have the very fixed costs like rent, the very fixed costs like Bloomberg terminals. You've got things that that the firm is paying for, things like insurance and taxes. Of course, we're a business that produces a thoughtful product, but needs to find a way to engage with clients, and so entertaining clients and hosting events, for example, is a certain segment of the expenses that we have. But it's pretty simple. It is a business. It's a very competitive business, first and foremost. Lots of people are calling themselves agency broker-dealers. And so in order to try to maximize the opportunity that we have to participate in that transaction execution process, we've got to really lead with value, with a thoughtful product. But as you outlined it, that's really the business model is very simply trying to engage clients meaningfully, be a part of their execution process, and of course we've got certain fixed costs that just come along with being up and running each day.
Well, I think you guys are kind of an institution now. You've been around for a long time, but were there any lean years along the way?
We've had the benefit of some clients that have just been greatly supportive from an early standpoint. I think that we've had a couple of phases of growth. So I think the early days we probably leaned more on our idea generation than we did on our execution. So in 2012, Brian Beer, who's one of our partners and formerly ran derivatives trading at Nomura, was also a large book runner at Bank of America during my days there. So he joined to run sales and trading, and reasonably soon after he joined, Drew Foreman, who's another partner, also co-runs the sales and trading effort with him, joined. And I've always thought that the execution process is really interesting. It's pretty easy to make the statement that execution is commoditized. We live in this world of incredibly tight bid offers on the screens. This is in the equity options product, at least. And you can press a button and voila, you've bought a bunch of options on the S&P or the triple Q. These things are pretty liquid. There's a lot of screen-based liquidity. So it's easy to make the statement, well, execution's commoditized. I would argue that the feeling of being in consistently safe hands from a buy-side standpoint, that feeling of being in trusted hands is not a commoditized feeling when it comes to execution. And what Brian and Drew bring is just a very, very thoughtful, years and years and years of perspective in developing a process to get large trades done. So some of our trades can be multi-legged. There's many, many tens of thousands of contracts, and there you're not going to be able to just press a button and hit the screens. You've got a real process where you've got to think thoughtful. You got to be very, very thoughtful around how you approach these orders, how you source liquidities, and that's really, to me, where the rubber meets the road from an execution standpoint. So that's kind of phase two of our business. We've always had a very thoughtful and valuable way of approaching the business of risk and specifically options, but then starting to really build out this execution desk, I think, has been a real meaningful phase two for our business.
I was in New York a week or two ago, and I was talking to some folks at some of the banks on the execution side, and these guys are praying for higher volatility, and they're more or less praying for a crash. They're praying for something to get markets to move. And it's kind of weird because, I was thinking about my time at Lehman 10, 15 years ago, and certainly nobody was praying for a crash. I mean, if you worked for a bank, you wanted a bull market. You wanted issuance. You wanted the equity business to be good. You wanted fixed income to be good. But now it almost seems that the dealer side is rooting for the opposite to happen, just to get some volatility going, to get trade execution back. What would you say to that?
Yeah, I think there's a certain difference right now, which is an incredibly low vol period, pretty low volume as well, and the period leading up to the crash, which was also very low volume, very low volatility, but presented a lot more opportunity, I think, for the banks. First, their own prop books were much bigger. At least nominally, they're not supposed to be prop trading at all these days. The sell side prop desk became quite a big player on the street during the period leading up to the crash. So there was more opportunity for profit. Bid offers were wider in the period leading up to the crash, even though volatility was quite low. And then I think what's so unique about now, and this is where I think the bulk of the complaining goes, is that even as you look at volumes, it's really hard to say how much of that is just some sort of robot, some sort of algorithmic, systematic strategy versus the street and specifically the sell side desks are going to thrive more on the discretionary trade, and it's that incremental discretionary trade that's not that's harder to come by from the buy side. So I think that some dose of volatility would certainly be helpful to the sell side at large, and frankly to the buy side too. It's an opportunity to differentiate the product and the research that you're doing in terms of trade implementation against just a purely passive strategy. But there's no doubt that vol and volume tend to be pretty correlated, and we're in one of those sideways periods where there's just not a ton of trading activity going on.
Yeah. One thing, and then we'll get to the commercial break. What would you say is the one thing that would keep you up at night? That you're going to wake up tomorrow and it's going to be gone. What's the biggest threat? I have those bad dreams too sometimes.
Biggest threat to markets?
No, to your business.
Well, I think that as I was alluding to, the discretionary nature of trades is, as the money starts to just flow into passive, and as the more active strategy has sort of failed to generate enough alpha, I think that's where the volume. We're a volume business, even though we're really a thought leadership business first and foremost. We monetize it through volume, and that generally works just fine. But when volumes get thinner, every sell side firm has to consider that. So as more and more money goes passive, I think that's certainly a consideration. And I think back to your comment on the people on the street rooting for a crash, I think that there's some notion of just hoping that the client-driven strategies can differentiate themselves against a more passive style and of course low-cost style into the next risk-off period.
All right, let's take a quick commercial break. Just want to let you guys know, if you're interested in reading my stuff, a good starting point is the 10th Man newsletter published by Malden Economics, and it's absolutely free. Free as in free, it doesn't cost anything. The name of the newsletter actually comes from World War Z, if you ever saw that. To sign up, all you have to do is go to www.10thman.us. That's www.10thman.us. That's 10th as in number 10. It's a good introduction to how I think about markets, and there's plenty of funny stuff in there too. Just go to www.10thman.us. So let's talk about vol. Let's get to that part of the discussion. There was a piece in the Wall Street Journal, I think it was today or yesterday, that talked a lot about these retail day trader short vol carry guys, and I'm hoping you read this article. I mean, it's great. It's classic Wall Street Journal, just great journalism. You know, they interviewed this guy who said he'd made, you know, $53,000 in a month playing short VIX. You know, you have to believe, and this is obviously just one anecdote, but you have to believe that there are just thousands and thousands of these guys out there. So if, you know, do you think that we are, I mean, look, like 15 years ago, it was fooled by randomness. It was Nassim Taleb. It was everybody buy options. And in 15 years, we've completely flipped. And it almost seems like there's a bubble in short vol strategies. What do you think?
I think that winning trades attract sponsorship. That's that's an unmistakable conclusion about the the power of the purse. When you see something working, either you see it working for someone you know, or you read it in the newspaper, or if it works for you personally, that draw is kind of irresistible. And what's working and what's not working. There's a lot of conversation about how low the VIX is. That being said, it's just not low enough for the folks that are taking the short VIX trade, the short volatility trade. And there's a number of different ways to set these trades up. But the reality is that the VIX is 10 and the realized volatility on the S&P is something significantly less. You've had periods where the realized volatility in the S&P has been 3. It's been as high as 8 recently, but it's still well enough below where you can sell options to comfortably make money. So there's a couple of things about right now, specifically about this short volatility trade that are, to me, that are unique. The profits from short volatility are not unique. Jared, you've been doing this a long time. You can go back to the early 90s and just draw a graph of the spread between the VIX and the subsequently realized volatility in the S&P. And sure, you'll see some sharp drawdowns in 98 and 02 and 2008, 2011, 2015.
Throughout most of the 90s, it was huge, though.
A thick spread, right? A comfortable spread between the implied and the realized. That's the essence of selling volatility, is based on that consistency of that spread. However, what we have seen, as I mentioned, is invariably the short volatility strategy, and this is sort of the essence of what Taleb says, it makes money most of the time. And this is sort of part of the problem. People get drawn to it, and you wind up doing trades that, while they are likely to make money, the odds aren't great. And so you get these very sharp drawdowns where suddenly the VIX goes from 10 to 30. And the folks that consistently were making money lose a ton in a hurry. What's unique about the current period is the lack of that kind of feedback into the market. So if I had a trade that made money most of the time, but occasionally I lost a substantial amount, that's a certain kind of risk profile. That's a short vol risk profile. These days, you could make money almost all the time on the short vol trade, but even when you get a drawdown, the drawdown is just tiny. And I just think about the allure of that, the Sharpe ratio that comes from the consistent posting of positive returns, even as the volatility of those returns is very low, is incredible. So I'll throw a stat at you that there are these systematic short vol indices that are investable indices that dealers make available. And so since the Trump administration, since Trump came on, and everybody thought Trump was going to be a big source of uncertainty, a big source of volatility, and it's just been, the uncertainty part, I think, rings true, but the volatility part certainly doesn't. The Sharpe ratio of a short volatility strategy that sells volatility on the S&P 500, you're looking, depending on the specific index, you're looking at a Sharpe ratio of between 5 and 8.
Oh.
So to put that into context, a 6 Sharpe ratio is 20% return with a 3 vol, right? These are probably unsustainable levels, but they've sustained themselves for long enough that, back to your original question, I cannot help but to think that there's not more and more capital flowing into what just seems like a layup type trade.
So, going back 10 or 15 years, a lot of the vehicles which people use to put these trades on didn't even exist. So, what do you think about the thought that some of these vehicles that enable people to put these trades on, are they beneficial, not beneficial? And I'm referring to the whole VIX complex, VIX futures and options, the ETFs, the leveraged ETFs, that whole complex.
Yeah, I think I think what's really been important has been they redesigned the VIX. This is the early part of the 2000s, and they decided that they could remember the original VIX was the front month implied volatility for a put and call with the closest to the money strike and one at the money strike. And that was it. In the early 2000s, they set out to make the VIX more representative of the entire, what they call, strip of S&P options. So it's something that brings to life not just the at-the-money implied volatility, but the out-of-the-money puts and the out-of-money calls, a whole sequencing of different strike prices. And then they created VIX futures, which took a little bit to carry on, and there was a lot to catch on. There was a lot of skepticism. And then they created VIX options. No one had any idea at all how to price vol of vol, right? So it's the implied volatility of something that is itself volatility. But eventually, things started to click. It's sort of this thing, this virtuous cycle of liquidity. Liquidity begets liquidity. And I think one of the most important things was the VXX. The VXX, which is a ETF that simply rolls VIX futures each day, caught on and started creating more liquidity in VIX futures, which created more liquidity in VIX options, and just people got more and more comfortable trading. As I said, liquidity begets liquidity. And then you had the second generation of products. Of course, everybody needs to have a 2 times VIX and a 2 times inverse VIX. So we got a couple of those. And you've got a pretty vast ecosystem of product built around the VIX. Now, those are just the products that we can see. Those are listed.
Now you got variance swaps, and
you have, right. So you have variance swaps, which is volatility based on options, purely a synthetic form of trading volatility. And I think that the most recent generation of products is really it's the OTC version of VXX and all its variations. And this is where the dealer creates its select index. They've all got fancy names, but it is some version of, here's a tail risk trade you don't have to pay for. The whole goal is, how do I find a hedge that carries neutral? And of course, the back testers get to work.
That's the holy grail, yeah.
The holy grail, and we should always be skeptical of those types of trades, because they do much better in the back test than they do in the forward test. But I can't, again, stress that the sizing of the OTC segment of volatility products, and I'm not just talking about OTC options or variance swaps, I'm talking about these third generation VIX and VXX-like products that you can engage a dealer with just on a total return swap. I think these are pretty vast as well. So it's a new kind of market, and where I get concerned is that there would seem to be a lot of capital leaning the same way. And the reason I say that is I talk to a lot of people, and I hear that. There's nothing that's been a more consistent moneymaker than selling volatility or playing the shape of the VIX curve. So it's the products themselves are worth really analyzing in light of trying to understand market risk.
So this whole ecosystem, would you say that it's fragile or stable? And the reason I ask is I remember sitting with the index vol guys in like 2006 when variance swaps were just getting really popular, and I used to call variance swaps scariant swaps. And I could not believe that people would trade something that had quadratic, unbounded downside risk. And I was pretty convinced that in the event of a crisis that there would be a failure in the vol market. And the funny thing is the vol market in 2008 performed just fine. So now obviously I think there's a lot more leverage in the system. So back to the original question, do you think it's fragile or do you think it's stable?
You make some really good points there. And so to the squared nature of a variance swap, especially one that has a low strike, the convexity, as they call it, in these very low strike variance swaps is gigantic. And I too remember certain clients actually selling. I'll never forget, there was a sale of a variance swap at the end of 2006 at a strike of 9.8. And you throw a vol number in there of 25 even, and on a small trade you have a gigantic loss. You get to 80, which is what the 1 month realized vol of the S&P was in November of 2008, and now you have a catastrophically large loss. So I do think I like that word, scariance swaps. You also make a point, which I think is a really good one, which is the vol markets, the U.S. equity listed vol market. It was the poster child of what you want a risk transfer market to look like during those very challenging days of late 2008. Bid offer spreads were wider. Vol was incredibly high. Vol of vol was incredibly high. But this market was open for business, jammed a tremendous amount of flow through it over that, again, incredibly volatile period. I think it actually kept the other markets together. When you look at, for example, what happens in CDS versus the bond market, both of them can dry up simultaneously because there's just not enough. The listed screen is just not vibrant. There is no listed screen really for either one. And I think being able to fall back on that listed, pretty electronic oriented market making capability, I think is important. On the fragileness question, it's something that we here at Macro Risk Advisors debate a lot. We think about this all the time, and it's a really tough one to answer. I think that there's certainly elements that look fragile. So some of our work suggests that on a not even a large spike, but a VIX that goes from 10 to 16. Now 16 isn't all that high. That's a kind of 1% move in the S&P each day. But the move from 10 to 16 and the way in which the positioning and just the mechanical rehedging that some of these VIX type products, so the TVIX type product, there's a mechanical rehedge that needs to come when vol goes up. So think about the amplification of volatility where you have a forced buyer of VIX futures that's just responding to the fact that the VIX went up. Those numbers are as high as we've ever seen them right now. So when I step back and I think about the elements of something that's fragile, I think about those amplifiers, and I think about all of the folks that I talk to that essentially are charged with hedging for their firms. And we may think volatility or option costs are low. Being able to actually fund those hedges is near impossible for folks right now. So the preparedness seems very low to me, and those are all ingredients to a fragileness. I'll say, look, I'll balance it and say we had a incredible shock to the system in August of 2015. VIX at 13 on a Wednesday, and August 24th, VIX tries to open at 52. It takes a long time to get open, closes that day at 40. So we survived. VIX is at 10, right? So, yeah, I don't think we should underestimate the ability to absorb this stuff. But again, there are certain elements that do feel more fragile than they felt to me in a long time.
Well, we're kind of running out of time. So I'd like to continue this for like another half hour, but we just can't. So I don't know if you've listened to the podcast before, but what I do at the end is I have a speed round, just like I have in the Daily Dirt Nap, and I put in funny stuff in there. And I usually tailor the speed round to who I'm interviewing, but I don't know like what movies you like or anything like that. So this could be like a complete bust.
If it's a bust, we'll just not included.
All right, so let me get my speed round here. Okay. So I'm just gonna ask you a series of short questions. And
am I answering just like one word, or is it just like stream of consciousness?
Just one word. Just one word.
Okay.
Best Vin Diesel movie.
Boiler Room.
Oh, that's a good one. Yeah, I agree with that actually. Best movie about submarines.
Crimson Tide.
I totally agree. We're 2 for 2. I actually just watched that like a couple weeks ago.
Go Bama.
You would rather listen to a spoon in a garbage disposal than this music.
Muzak. I think.
What is your favorite Fed official?
Current Fed official?
Yeah, current Fed official. Somebody, president or governor right now.
Probably Stan Fisher.
Okay, that's a good choice. Is Seth Rogen funny or not funny?
That's a great question. He is still funny. It's been trending down.
Trending down. Yeah. Are you familiar with the show Ridiculousness on MTV?
I think so. I think is that the one with the practical jokers?
Yeah.
Or no? Okay.
What I was going to say is Ridiculousness a guilty pleasure. It's a huge guilty pleasure for me.
Yes.
One serious question. What is the most painful P&L lesson you've ever had to learn in the markets?
I think sizing trades is what everyone that's the holy grail, is how do you effectively size your trades. And I think that's what most people would say. They've missized something.
Yeah, there's only 2 sizes, too big or too small.
Right, exactly.
If people want to learn more about MRA, where do they go?
Our website's a good description of our business, macroriskadvisors.com.
macroriskadvisors.com. Okay. This concludes the 6th episode of the Monthly Dirtcast. Thanks to our guest, Dean Curnutt. Thanks to Blake Gerald for letting me use his track Punta del Este. And if you want to learn more about the Daily Dirt Nap, go to www.dailydirtnap.com. That's www.dailydirtnap.com.